Hello friends, welcome to Super Traders, the beginning. I am Saurabh Khandelwal, your host for the workshop. I would like to thank you for signing up and for watching this video. I have made this pre-session video for all the participants. I know many of you must already be possessing this basic knowledge, must already be trading on these basics, but I still recommend you go through these videos so that this will act as a brush up. And for those who are new, this is a must watch. You can make notes while watching these videos so that we start on one page on the workshop day. All right, let's begin. So any technical analysis, any technical system is purely based on the price movement of a stock. And how is price depicted on a chart is through candlesticks or through lines. So we'll be studying some basic candlesticks and basic candlestick patterns through this video. So what is a candlestick? Why it is called a candlestick? Because it looks like a candle. It has a body just like a candle, and it has shadows, upper shadow and lower shadow. Shadows are also called wicks. So we can call upper wicks and lower wicks. Candles could be of many colors, as different charting softwares, different paid softwares, different websites show different colors of body. So a white body or a green body or a blue body will mean the same, meaning a bullish candle. And a black body or a red body will also mean the same, meaning a bearish candle. So what is bullish and bearish? Let's discuss this. This is a bullish candle, a green candle. So any candle will have four properties that will tell us the opening price, a closing price, a higher price, and a lower price. A candle could depict a day, or a week, or a month. So for this illustration, we will use this as a daily candle. So we'll see during the day, the price opened here. As we say, this is an opening price. During the day, it moved downwards, making a low. This was the lowest point of the day. And then it started moving up and made a high. This is the highest point of the day. And then it closed here, resulting in a green candle. Reason? The opening price was lower than the closing price, or we can say the closing price was higher than the opening price, resulting in a positive candle or an uptrend or an up price movement during the day. That's why we call it a bullish candle. The right opposite of this is bearish candle. It will have the same high price, it will have the same low price, but the opening will be higher than the closing. So we can say the price opened here, it moved and made a high during the day at this point, then it started moving downwards, made a low. This was the lowest point during the day, and it closed below the opening price, resulting in a red candle or a bearish candle. Next is a doji or a cross. It signifies the opening and closes prices were same. Though the price moved higher during the day, it made a higher point, and it also moved lower, a low point of the day. But it closed equally or marginally above or below the opening price, resulting in a no body candle. So a cross or a doji doesn't have a body. Next is a hammer. Hammer is a small body candle followed by a long tail or a long shadow. For this pattern to be called hammer, it is very important that the shadow should be twice the size of the body. I mean by that, the length of the shadow should be twice the length of the body. A very important pattern. So these were broadly four classification of candles. Let's see this pattern on chart. So this is the weekly chart of Nifty. and each candle denotes 1 week. So as we see this big white candle, so this was the opening price, it moved higher and it closed here. This was the closing price. So since the closing was higher than the opening, it resulted in a white candle. As you see, this is the red candle, a big red candle here. So why this resulted in a red candle? Because this was the opening price and it went down and closed here. So the closing was lower than the opening, resulting in a bearish candle. This could be a hammer here, a small body followed by a big tail. This is a hammer, and we can see a cross here. This is a cross or a doji. So this is how the prices are plotted on a chart using candlesticks. Now we'll see some two candlestick pattern. It means two candlesticks studded together, making a pattern. So let's see some two candlestick patterns. Though there are many patterns, but we'll be discussing some of the most important ones. So as you can see, the first one, it's piercing. This is a bullish pattern. So it means a body piercing into the previous body. That's why it's called piercing. So you can see a red body. Red body, as you all know, as I explained earlier, a lower closing than the opening, resulting in a bearish candle. And the next day, price opened lower than the previous day close. So this was the previous day close, and this is the today's opening. And then the price started moving upwards, resulting in a green candle, and it closed above the 50% mark of the previous body candle. Then it's called a piercing pattern. So it is a very significant pattern, as is also signifies a reversal, very important pattern, and the probability will be higher. The probability will be more higher if it pierces more deeper into the previous body. So next is bullish engulfing. As you understand by the meaning of engulfing, that a green body engulfs the previous red body, then it's called a bullish engulfing pattern. So it should engulf completely, like this is the red, you can see, and the green body is bigger. It's engulfing completely the red body. It should engulf completely, then it's called a bullish engulfing pattern. Next is bullish harami pattern. Harami is a Japanese word meaning pregnant. So you can see a small green body after a big red body or a big bearish candle. So it signifies that bears are losing their control and bulls have started taking the control. It is also a very significant pattern. So let's see this pattern on charts. All right. So this is a daily chart of Atul Limited. And as you can see, there was a downtrend here and then a big red body followed by a green body. This is the closing. And the price opened lower than the previous closing and started going up, and it closed above the 50% mark of the previous body. An ideal example of piercing pattern, and a very significant one, because as I told you earlier, higher the penetration, higher the probability of a reversal. And you can see how the price moved up. It was a trend reversal, a very powerful pattern. This is bullish engulfing, daily chart of Bajaj Auto. As you can see here, a small red body completely engulfed by a big white body. Again, back-to-back engulfing. Again, a small red body and engulfed by a big white body. This is a bullish engulfing pattern and signifying bulls coming back in control, and see the price start moving up. This is a bullish harami pattern here. A big red body followed by a small white body, a white body which is within the body of the previous candle. This is a harami pattern, bullish harami pattern, again signifying that bulls are back in control of the situation. All right, so let's proceed. These are bearish patterns. So dark cloud, it is just the opposite of piercing. So we can see It is again a very significant pattern as it shows a reversal. So you can see a green body. This was the opening, this was the closing. As closing was higher, resulted in a green body. And again, the price opened higher than the previous close. Price opened higher than the previous close and started moving downwards. And it closed below the 50% mark of the previous body. Then it is called a dark cloud pattern. The significance is very important, very high, and the higher the probability, as higher it goes down. Yes, next is bearish engulfing pattern. So it is same as bullish engulfing, but difference is that a red body follows the green body, and red body is completely engulfing a previous green body, showcasing that bulls have lost their power and bears are back in control. Next is bearish harami pattern. A small body followed by a big body. The small body should be within the previous body of previous candle, and it signifies that bulls have started losing control and bears are coming back. So let's see these patterns on the charts. All right, this is daily chart of Arvind Limited, and as you can see, there is an uptrend. You can see the uptrend going here, and then we see a white body, and this was the closing. Then the price opened higher and started moving downwards and closed below the 50% mark of the previous body, resulting in a dark cloud pattern. It is very significant as the probability becomes very high because it closed below the 50% mark of the previous body. And you can see the result. The price moved down. This looks like a crash to me. A very significant pattern, dark cloud. Next is bearish engulfing. You can see a blue body, white body, followed by a big red body, completely engulfing the previous body, completely engulfed. Very strong pattern. And you can see the aftermath. The price crashed and started moving downwards. Bearish harami pattern. A big white body followed by a small red body within the previous body of the candle. Again, a significant pattern. It shows bears are coming back in control, and you can see the price moving down. So these were some of the most important 2 candlestick patterns. So next is 3 candlestick pattern. As we talked about 2, now the 3 candlestick pattern means a pattern which includes or which has 3 candles all together. So we'll see only the most important ones, though there might be some other significant patterns, but for the sake of simplicity, we'll be discussing the most 2 important. The one is evening star, which is a bearish pattern, and another is morning star, a bullish pattern. So we'll see an evening star after an uptrend. So say there are 4 to 5 green candles showing an uptrend, and then a cross appeared or a small red body appeared. And then on the 3rd day, the price opened down with a gap and started moving downwards and closed below the 50% mark of the first body. This is again important. Closing below the 50% mark of the first body. Then it's called an evening star. And higher this penetration and higher the probability of its success. The opposite of it is morning star. So when we see a series of red candles, 4 to 5, 6 candles maybe, showing a downtrend, and then a small green candles appear, or a doji appears here, or a hammer appears here, and then the next day the price opened higher with a gap and started moving up during the day, and it closed above the 50% mark of the first body. It is called a morning star. So higher the probability of success, when higher is the penetration. So these are 2 most important 3 candlestick pattern. Let's see them on charts. So as you can see, this is Bajaj holding a daily chart, and you can see the downtrend, a clear downtrend, and then finally this pattern appeared here. You can see a red candle, then a gap down, again a red candle, and next day it opened higher. This was the closing price, and opened higher and started moving up during the day, and it closed above the 50% mark of the first body, it is the most ideal condition for a reversal. So higher the penetration of the third candle, higher is the probability of success. And you can see the price started moving up from here. There was a reversal of a trend. Next is evening star, bearish pattern. So you can see a clear uptrend here, and then a big white body followed by a small red body. And then the third day, though the price didn't gapped up down, but it's again a very effective reversal, effective evening star pattern, as the price closed almost on the 50% mark, or probably below the 50% mark. Again, a very strong reversal pattern, a must watch pattern always. And as you can see, the pattern depicted the reversal. All right, so this was it, guys. Thank you so much for listening to this video. I hope this video was very useful to you, and see you soon on 27th. I'll be waiting for you. Thank you once again. Bye bye.